This model represents what we call the macro asset perspective, or the MAP. It's designed to give you a visual picture of where assets can be placed and, more importantly, why. The vertical arrangement of these boxes represent the concept of vertical diversification. That is the safe, the moderate, and the aggressive arenas. Now, whether you're talking to a banker, a financial planner, insurance agent, stockbroker, accountant, they'll all speak of these three broad areas of diversification. And I think you'll agree it's a good idea to diversify at least in some way or another. Now, why is that such a good idea? Well, let me explain. The assets accumulated above this line are often referred to as paper assets. And that's because they have no fixed value until the time that they're actually sold. I want you to think of your 401k statement, for instance. If you're investing in stocks or stock mutual funds, well, the value goes up and down based on a number of factors, all of which are outside of your control. Now, you hope that it only goes up, but the reality is it moves in both directions. Now, assets below this line represent real wealth. They typically don't go down in value. They remain fixed or stable and usually pay dividends or interest. Now, your personal diversification, how much you have invested above or below the line, is based on a number of factors. Your age, your risk tolerance, your holding period. The Wall Street rule of thumb would suggest the percentage you have invested below the line be equal to your age. So, for example, if you were 20, you might have 20% safe and 80% aggressive. If you're 80 years old, you might have 80% invested conservatively and 20% at risk. So over time, vertical diversification, in addition to risk management, helps us to understand how to convert paper assets into real wealth. Now, vertical diversification has been touted for decades, but emerging more recently is another important idea, and that's horizontal diversification. That's the diversification between tax treatments, and that's why we have 6 boxes instead of just 3. Now, this is a fairly simple concept to understand because there's only 2 types of tax treatments when it comes to our savings and investments. There's pre-tax and there's after-tax. Now, when I say pre-tax investments, what do I mean? Can you give me an example of one? You know what, that's exactly right, our 401k plan. Another example might be deductible IRAs. Another example, if you're still fortunate enough to have one, might be a defined benefit pension plan or a pension plan of some sort. So these are all tools that we can use where the money that we save or invest is done so before we pay taxes. So these are called pre-tax investments. Now, everything else pretty much goes over here on the after-tax side. These are savings and investments that we make after we pay taxes. So by definition, they're called after-tax investments. Now, over the years, people like me have said, and you've probably heard, that you should concentrate your efforts on the pre-tax component. Pump as much money as possible into anything that's considered pre-tax. Now, why was that such a good idea? What was the advantage? You know, that's the correct short-term reason, but it's not actually the correct long-term reason that this strategy worked. I'm going to start a sentence, and I bet you'll be able to complete it. I'm going to defer taxes during my high-income earning years because later, when I begin to draw the money out, I'll be in a what? Yeah, that's right, lower tax bracket. That's exactly right. And that's been the mantra for over 40 years. Interesting, though, how seldom people answer that today. And that's because most people don't actually believe they'll be in a lower tax bracket in the future. You know, let me explain. What do you think the highest tax bracket was back in the early 1980s when these pre-tax plans were popularized? Take a guess. You know, actually it was 70%. 70%. And there were 15 different tax brackets. So if your income went up a little, you'd go up a few brackets. If your income went down, you'd go down a few brackets. So a couple back in the early 1980s who was earning over 100 or earning 100,000, would have been in a tax bracket of over 50%. So here was their thought: hey, we'll defer taxes during our high income earning years, because later when we draw the money out, we'll be in a lower tax bracket. And for these folks, it worked exactly that way. They deferred taxes at 50, 60, maybe even 70%, only to draw the money out today in a 25 to 28% bracket. So it worked perfect for them. Now scroll forward to today. Let's say we have a couple that earns $100,000 in annual income. When their income drops to $80,000, or if it does, well, how many brackets do you think they'd move? I'll give you a hint. It's a round number. 0. And that's because today there's only 7 different tax brackets. And the highest tax bracket is 39.6%. So when someone retires, they're not automatically going to be in a lower tax bracket like they used to be. Now, another very real concern is the possibility that we have higher tax rates in the future, as some are predicting and as history would seem to suggest. So now if I defer taxes at 25 or 28%, only to pay taxes later at 35, 40, or maybe even 50%, well, that's a major mistake, isn't it? And the old mantra is not working anymore. So how do I deal with this potential problem? Well, first let's talk about what not to do. Don't go out and cancel your 401k contribution as some are advising. The pre-tax component is still a great place to accumulate wealth if used properly. But we do need to pay attention to the relationship between the pre-tax and the after-tax component. Okay, so let's look at a way that we could use this strategy very effectively. And the idea is simple. The idea is to accumulate dollars on both sides of the tax fence. So what I'm drawing here are bags of money. Okay, so let's say for instance, if I wanted or desired $80,000 in retirement income annually. Now, if all of that income came from the pre-tax side, well, how would that be taxed? That's exactly right. It'd be 100% taxable income, which is only reasonable, right? Because I've paid taxes on the savings and investments as they went in. I've paid taxes on the money as it's grown. Now, I'll have to pay taxes as I draw the money out. And as I mentioned earlier, that's an unknown factor which could potentially be quite high, because that will depend on the prevailing rates or prevailing tax rates at that time. So let's say instead that I only took out $40,000 from my pre-tax bag. Okay, well now that would place a couple in one of the lowest possible tax brackets. And the old mantra would work again. I've deferred taxes in a high bracket only to take money out later in a lower bracket. Now, I wouldn't have to live on that money by itself, because what if I was able to take an additional $40,000 out of my after-tax bag? Okay? Now, ideally, I wouldn't pay taxes on this money. Now, that doesn't happen automatically, but there are ways to accomplish it. But the idea would be to have a tax-free flow of income coming out of the after-tax side. And again, as I mentioned, it doesn't happen automatically. There's ways to accomplish it. We'll talk about that later. But for now, let's assume that we have no taxes coming out of the after-tax bag. All right, so now this couple's in one of the lowest tax brackets that exists today. They're in the 15% bracket. Now then, I don't know what that tax bracket will be in the future, but low tax rates tend to stay low. In other words, those at lesser incomes tend to pay whatever low tax rates exist at the time. Think about the debate among lawmakers. It's always about whether to increase taxes on the rich or not, right? Or on the wealthy. It's not about increasing taxes on those at lesser incomes, right? So, at just the right time, my total tax rate on my retirement income stream, okay, is 7.5%. Okay, this is all taxable, and over here I have tax-free income. And after all, I haven't saved all this money over the years, so I'm not saving it for right now. I'm not even saving it because I want a tax deduction right now. I'm saving it so I can have as much income as possible when I retire someday. So this is the strategy, And now let's look at the tactics in order to accomplish this. And I'm going to start by defining your 401k handbook's principles on diversification by placing all of your assets, at least in most cases, above the line. Okay? Now let's talk about why. Let's talk about why. What are the advantages of investing below the line? Well, one is what this S stands for, right? It's safety. Safety. And I want you to think about where this money might be if it's safe, right? It might be in your checking account, or it might be in a money market. And what's the advantage of those types of accounts? Yeah, that's right, liquidity. And there's another advantage, a third advantage, and it's tax advantages. And there's still tools that have tax advantages, and many of them are found below the line, with tax-free municipal bonds being the standard example. Now, do I need tax advantages, such as tax-free municipal bonds, though, on the pre-tax side? No, because on this side, I'm taxed according to the plan, not according to the investment. So when I begin to draw the money out, I'm going to pay taxes on everything that comes out, regardless of where it's invested. So I don't need tax advantages on this side. Well, how about liquidity? Do I need liquidity? Well, I need liquidity, but not on this side. For money that I don't plan on touching for the next 15, 20, maybe 30 years, I don't need liquidity over here. Now, what about safety? Do I need safety? Well, I need safety to some extent, but what kind of safety do I need? Well, on this side, below the line, I have short-term safety, day-to-day safety, right? What I have today, I'll have tomorrow, plus dividends or interest. But that's not the kind of safety that I need on the pre-tax side. I need long-term safety. Long-term safety. What does long-term safety look like? Well, let me explain. If I'm going to have this asset 20 years down the road or so, okay, it's critical that I'm able to outpace what? Yeah, inflation, right? And traditionally, the place that I've been able to outpace inflation has been with assets that are held above the line. So long-term safety on the pre-tax side kind of looks like this, right? That's long-term safety above the line. That's my highly analytical graph of the stock market. Now, so historically, the place where I've had the most success in outpacing inflation has been above the line in the stock market. And the longer the holding period, the better the chance I have of outpacing inflation. Now, this is a good time for me to interject something, and I call it the first rule of accumulation, and that is take the free money. And where am I most likely to find free money on the pre-tax side? Yeah, that's exactly right. Your 401k plan or your employer-sponsored plan, right? And so, generally speaking, we recommend that you save money at a rate that maxes whatever employer matching dollars exist in their plan, right? Take the free money. Now, so the most important box on the pre-tax side is this box right here. That's the most important box in our map diagram on the pre-tax side. Now, but if that's all I've done is put money above the line on the pre-tax side, I've got a problem, don't I? And what's that? Well, that's exactly right. I don't have any vertical diversification. And the first point we made today was the importance of vertical diversification. So I'm going to get my vertical diversification on the after-tax side. That's where I'm going to go to find it, and I'm going to go below the line on this after-tax side. Okay, so all of these components that had very little value on the pre-tax side are extremely valuable on the after-tax side. Safety, liquidity, tax advantages. Very advantageous over here. While the above the line box on the pre-tax side is the most important, this box down here is the most important box on our after-tax side. Now there's three basic places I can go on the after-tax side below the line, because remember, I'm looking for tax-free income if possible. One we've already talked about before. That's municipal bonds or muni bonds. Okay. A second would be cash value life insurance. And a third would be the Roth or the Roth IRA or the Roth 401k. Now all of these, if I qualify and if they're set up properly, can be used to provide tax-free income. Okay? So again, if I follow the rules and use any of these three, well, I'll be able to receive tax-free income. Now then, municipal bonds, we'll typically use those in a situation where someone has a lump sum of money and they're close to retirement, or maybe they're already in retirement. Now, if somebody has time to accumulate money, and if they qualify, and more importantly, if they're like you and they have people that depend on their income, well, then we'll use cash value life insurance. Now, the Roth, we typically don't use it over here. It fits better above the line than it does below the line. So we'll typically use it up here, not down here. And we'll talk more about that later. Okay? Now then, what rate of return might I hope to get below the line? What rate of return would be a good return? Yeah, well, 1 or 2% might be good today, but historically, for safe money, what's a good rate of return? Yeah, that's right, maybe 4 to 5%. Now, but remember, this is all growing tax deferred, right? And I can access it tax-free. And so if it's growing tax deferred, well, maybe that's like a 7 or 8% tax equivalent yield, depending on someone's tax rate. Okay, so for example, if I had money in my bank account and I was somehow able to earn 8%, well, if I earned 8% and then I paid taxes on that 8%, I would net 4 to 5%, again, depending on my tax rate. So for something that's growing tax-free, right, and earning 4 to 5%, well, that's a tax equivalent rate of return of 7 to 8%. Now, 7 to 8% isn't bad. That's not bad, but it's not what we hope to make above the line. Above the line, we might hope to make 10, 12, 15%, maybe even 100% on our investment. But the idea isn't to compare, it's not to compare safe, conservative investments to aggressive, risky ones. That's not the object. The object or what we are trying to accomplish is to get as high a return as possible on our assets that we hold below the line, on our real wealth. Okay? Now, many people do, and many people should, have assets above the line on the after-tax side. Okay? One of the best places to put money above the line on this side might be into a Roth IRA or a Roth 401k. There's another product that some people will have access to, and that's an employee stock purchase plan. Okay? And in one of these type plans, we'd talk about the other rule of accumulation, a little bit different take on it, but it's take the discount. So you can typically purchase stock at a discount, again, if it's available through your employer. And guess what? You're taking that discount, so it's essentially free money on the back end. Now then, there's other places that people might go. Some people like to invest in precious metals, such as gold. Maybe I have money in real estate. Okay, the classic example is to invest money in the stock market. And some will say, you know what, I'm going to invest in my business or a business. And the goal up here is pure appreciation. I'm not as concerned about how the growth is taxed as I am about pure capital appreciation. Now then, the idea is this. As I accumulate wealth up here, that I'm able to funnel those profits below the line. Okay, and I do this by using what's called annual asset reallocation. Okay, so for example, let's say I have growth up here and that all of a sudden I have 60% of my wealth above the line over here and 40% below. And maybe I wanted a 50-50 blend. Okay, well, I'm going to move 10% from above the line, from paper assets, down below the line into real wealth in order to keep my portfolio balanced. If the opposite occurs, and maybe I accumulate more wealth below the line. Maybe we're in a down market or a down economy, and I have 60% below the line and 40% above. I can funnel money back to the back above the line in order to balance my portfolio. Does that make sense? Okay, great. Now the question is, how much should I have, or what should my diversification, look like, right? So as I start pumping money into the MAP model, well, where should that go? Well, a lot of times people will just split it evenly. So in other words, I'll have 50% on the pre-tax side and 50% on the after-tax side, right? Now let's talk about a few exceptions to that. Let's say that you're someone that earns $400,000 a year, right? And you'd like to have $300,000 in retirement income annually. Well, if I have $150,000 coming from the pre-tax side and $150,000 coming from the after-tax side, well, $150,000 in taxable income isn't going to put me in a low tax bracket, is it? So for someone in that situation, I might tend to put a higher percentage of my savings into the after-tax, tax-free area. Okay, does that make sense? Okay. Now, I might even have to do that because of limitations on the pre-tax side. Now, other example would be this. Let's say we have someone that earns $30,000 a year and they want to retire on $20,000 someday. So maybe that's Joe and Jill average, right? Well, they should follow the traditional plan that we read about in national newspapers and magazines of pumping as much money as possible in the pre-tax side. Because when they retire someday, well, being in a lesser tax bracket is really not going to be a problem for them. For the rest of us, if we're in between, well, a good place to start as we look at this might be to say, hey, let's put 50% here and 50% here. Now then, what about vertical diversification? Well, if I'm putting 50% on the pre-tax side above the line, okay, but I'm aggressive. Let's say I'm 45 years old and I'm aggressive by nature. Well, maybe I have 25% above and 25% below. Or maybe I'm a 25-year-old and that's the perfect blend to have 25% safe and 50% up here on the top that's aggressive. Okay, does that make sense? Now then, regardless of who you're speaking to, no one would recommend that you have less than 25% below the line in areas that are considered safe. Okay? Now then, most people are fairly knowledgeable, or have some at least working knowledge of how their pre-tax investments work above the line, right? Like in our 401k plan and such. But many people that we meet with aren't quite as knowledgeable about tools such as cash value life insurance. Well, how is your understanding in that area? Yeah, I hear that a lot. So what I'd like to do next is just give you a brief explanation or have a brief conversation about how cash value life insurance works. Okay? Hey, thanks for your time, and let's look over this for a few minutes.